Hello and good morning friends, welcome to CEC Live Lectures. Dear friends, in our previous session we discussed on new dimensions in Indian corporate finance. Today also we are going to discuss in detail on the particular topic, that is new dimensions in corporate finance, and we would be starting from where we left in the previous session. For this discussion we have once again with us in our studios Dr. Amarjeet Kaur. Dr. Amarjeet Kaur is a prolific and a dynamic professor. She is a professor of accounting and she is teaching in one of the leading institutions of the country. Friends, we would like to share that her dynamism is not limited to the country only. She visits as the guest faculty as well as the faculty in various universities in abroad also. She is a certified management accountant from USA. She has authored numerous books and a number of articles have been published in reputed journals. So let's welcome our guest Dr. Amarjeet Kaur, and friends, if you want to ask questions from Dr. Amarjeet Kaur on the particular topic, then do call us through our toll-free number. Our number is 1-800-110-430. I repeat, our number is 1-800-110-430. You are requested to call in the last 10 minutes of the lecture so that the lecture goes uninterrupted. Let's welcome our guest Dr. Amarjeet Kaur and let's have a deep insight into the topic. Hello ma'am, welcome to the lecture.
Hello Gitika. Very good morning to viewers. And welcome on the second part of latest dimensions in Indian corporate finance. So we will be talking about international finance, exchange rate risks, and then we will talk about forfeiture and forfeiting, factoring. So those few important dimensions which have developed recently, not in very long in the past. So let's start with international finance. So international finance means what? If we have to procure funds, one option is that we procure domestically from various sources, right? We can procure it by issuing equity, by issuing debentures, by seeking project loan, term loan from various financial institutions. So domestically, right? The second option is that we can procure finance, funds for our business while going internationally by approaching to international capital market, right? So today, because we have already discussed in the previous lectures about sources available, domestically. So today we will be talking about the international finance in the first half, that how can we procure funds and what are the different options available to a businessman, right? So moving forward, let's talk about the international finance first, and in that context, let's discuss about foreign exchange market in India, and then we will move to the different sources of finance available. So what is foreign exchange market? We all need a foreign exchange if we have to visit abroad, or if I'm a company, I have to settle my account. If I'm exporting or importing, I need to have foreign exchange access. So in our country we have a 3-tier system of foreign exchange finance. Tier 1 is a system where customers, individuals like me and you, or companies can approach to an authorized dealer to access foreign exchange. So now these authorized dealers are generally banks which have who have been authorized by RBI, Reserve Bank of India, which is the apex banking authority, and they can actually sell or buy foreign exchange. Other than these authorized banks, one can procure foreign exchange even on some authorized shops or hotels in the country. We have wherever we have certain locations where there is a possibility that tourists, especially the tourists, they come into interaction with those people, so they have been authorized. You would have seen, if you have traveled and you would have seen on the airport, especially the international airports where we have flights coming overseas, from overseas, we have specific shops which can exchange foreign currency into Indian currency and vice versa. So that particular set of foreign exchange system is known as tier 1 market, where exchange is happening between authorized banks and consumer, either individuals or companies. So that is one. Tier 2 is an exchange of foreign exchange happening between banks. So we call them as interbank transactions. So what are interbank transactions? One bank can sell or purchase foreign exchange from the other, and that transaction, whatever it, either sale or purchase happens on a particular day, they are required to square up on the same day through TT. So telegraphic transaction is something which is used, we call it as TT in financial terms. So banks are required to settle foreign exchange dealings, which is interbank exchange, on the same day of the transaction. So at the end of the day, they have the equal amount of sale and purchase. If they have sold X amount, they are going to buy the same number of either dollars or pounds. There are two important currencies which are targeted at in the country, which are actually exchange. We do exchange other currencies as well, but there are restrictions. So these two currencies, pound and sterling and the US dollar, they are the most commonly, the third is euro of course. So they are the most commonly exchanged currency in the country. So this is tier 2, where banks, they are exchanging amongst themselves and known as interbank exchange. The third tier, the third system or independent market is where banks are exchanging with Reserve Bank of India. So the Apex Bank in foreign exchange market for Reserve Bank of India, and here banks are basically selling and buying from the RBI. So in case of their need, because RBI is considered to be a bank of last resort, right? So this is the third tier. So in total we have 3 tiers in the Indian market to buy or sell foreign exchange, because this is in the context of international business. This is in the context when we are running our show internationally, we are a multinational company, or otherwise we are a domestic company but we are into export import. So then certainly the foreign exchange comes into picture. And because of this 3-tier system, mind you, we have different exchange rate. You will never get a reply if you approach to a banker and you want to buy foreign exchange. Most of the branches are not authorized. They will reach to their branch which is authorized, or we call them as authorized dealer. So you will not get foreign exchange from all the branches. So what happens, the moment we approach one bank, you will not get a certain answer easily. So they will say, okay, that this is the rate for today, let me try. And that is where the need to bargain comes in. We would generally like to bargain with the bankers even. So there is a scope of bargain to buy or sell the foreign exchange. You may have few denominations of any foreign currency which is actually allowed to be exchanged in the country. So and you want to exchange it for Indian currency or other way around. So there is a scope of bargaining even with the authorized bank. So the moment we have such kind of system, so it means there is nothing very, very certain and sure about foreign exchange market in even today. I am not talking about the past days, I am talking about the current scenario. Even it's not very certain that at what price you would be able to sell or buy. Of course, we have minimum price declared every day. It is there, it is available online, it is available in paper, and news channels do display that. But even after that, you would end up buying or selling at a slightly higher or a lower rate than shown in the dailies, financial dailies or news channels, or by the RBI on their website. So this is one point. So second point about this is that the exchange rate, this is one exchange rate available, right, which we would know as a consumer. There is another exchange rate which is certainly different than what we buy or sell at. The second rate is between the banks. So it is very much based on the tier system. The tier 1 is authorized banks and individuals or the companies, right. So we have one system or one exchange rate which is applicable for individuals or for corporates. And same way, the second exchange rate is applicable amongst banks. Now, banks are also selling and buying amongst themselves through TT, as I said, telegraphic, right? So, so that telegraphic transfer is also happening and at a prescribed rate, but again there is a scope of bargaining amongst banks. So that is a second rate which is on a particular day you would have second rate, and as well as the third rate available in the market. Now the third rate is amongst RBI and your authorized banks. So now this rate is again different than the previous two exchange rate discussed. So it means all the three exchange rates existing in the economy on a particular day would vary. So this is the point I want to bring into your notice. So in case you have to deal with the foreign exchange, either you are an importer or an exporter, this is something fundamental you should be knowing, right? Now moving forward, we will talk about exchange risks. So those rates which are, those risks which are pertaining to exchange rate are known as exchange risks, and there are three kind of exchange risks. The first one is economic risk, the second one is transactional risk, the third one is translation risk. So let's discuss about them one by one. The economic risk is basically the risk between, when you are dealing, let's take some example to understand, you would be able to. So first of all, economics risk is not very direct risk related to exchange, but it is known as indirect risk. So what is that? Let's assume you are an exporter. So you are selling some X product, let's say high speed cameras, right? So you are selling it and your competitor is somewhere sitting in Sri Lanka, a neighboring country. So one person, one company exporting from India, another company exporting from Sri Lanka. And let's further assume, I am not giving the accurate value of course, let's further assume the inflation rate in India is, let's say, 6% and the inflation rate in Sri Lanka is 11%. I will repeat, I am taking it as an example, not very accurate value I am taking. So if approximately in India the inflation rate is 6%, in Sri Lanka if it is 11%, so there is a difference of 5% in inflation, right? Now let's assume somebody buys goods from you or intends to buy from you, and the person sitting in US, so he has a particular rate in his hand, and he has a particular rate in his hand from Sri Lankan supplier. So both are the competitors. Now let's go further. Now let's assume Indian rupee appreciates, right? And so comparatively, if Indian rupees appreciate more than the difference of the inflation rate of Sri Lanka and India, then the appreciation in the currency of our country, India, would lead to the goods of higher cost to the person sitting in US, who is our buyer of course, so who intends to export from us. So goods to the buyer sitting in America or any other part of the world, in Japan or any other country, would become expensive, not because the exchange rate changed, but because of the inflation affecting the exchange rate. We call it as real risk, a real exchange rate. So real exchange rate is basically adjusted after the inflation percentage of the country. So this inflation figure would indirectly affect the buyer, and the Indian supplier, Indian seller would have no choice than to quote the price at a lower than the actual he has been selling at, so that he could compete with the price given by his competitor sitting in Sri Lanka. So this kind of risk is known as, we call it as economic risk technically, but this is actually influenced by inflation, the difference of the inflation rate between the countries who are exporters, who are in competition supplying the same product. Okay. So the second risk, as I showed you in the slide, is transactional risk. Now this particular risk is where when we have this particular risk will happen when the deal is in foreign currency. You are exporting, you are importing, and it is not compulsory that your deal should be only in foreign currency. Your deal could be in US dollars, it could be in UK pounds sterling, or it could be in euros. Nowadays euro has picked up a lot, or it could be in Indian rupees. So it all depends that how the deal has been defined for you. So let's say, and it is true for both importer and exporter, but the effect would be inverse in both the condition, right? So I am taking the case for discussion. Let's take you are an exporter. So you are exporting, and your sale deed is your sale agreement, your the memorandum of understanding to sell X product on X prices, but the price quoted is let's say US dollar. So now if in case dollar appreciates, let's take this way. So in case dollar appreciate and you are an exporter, you have already sold it, your sale agreement, your invoice says these many dollars, right? $10,000. Now $10 per dollar the price has gone up, it has appreciated. So you as an exporter will gain. So I have a very close person in the family who deals with services, and his clients are overseas in many countries. So if he is listening to me, he would know, he would be able to correlate this example that we so for times we have seen gain or loss because of this particular exchange, because the transaction has been defined in foreign currency, not in Indian currency. The moment euro goes up, he is happy, right? And the moment euro or dollar goes down, he is concerned that yes, my net income, my net revenue is going to go down because of the change in, and this happens to many more people whosoever is dealing in exports, and especially if their export is in foreign currency, not in Indian currency. In this example, we assumed the agreement was in US dollars. It could be in euros as well, right? And vice versa. So if it is a case of importer, then the effect would be adverse. You would be losing money because of appreciation. You would have to pay more. You are importer and your import deal is in euro, right? So now you have to pay. So when you have to pay in euro, and euro goes up. So today was your purchase day. Let's say today is 27th of September, and you have to pay after a month. You have to pay on 27th of October. And in case on October 27th this year, if in case euro goes up further, whatever the rate is today, by say 2 rupees per euro, then certainly it makes a difference to your deal. So you will have to pay higher. So exporter and importer, they have the risk of transactional risk in case their deals are defined in foreign currency. So this is the point I want to bring out. The third kind of risk which is related to exchange risk is translation risk. So kindly make sure there are two different words I am referring to. The previous one was transactional, when a transaction has happened in foreign currency, right? And now I am talking about translational risk. So the translation risk is precisely, it's a peculiar kind of risk only for those companies who have foreign operations, who have branches in other countries. So let's say I am a company and I have branches in other part of the world. In 7 countries I have branches. Now my branches which are there in other countries, they are selling there, right? So they are recording their sales in the foreign currency, whatever the selling price has been defined. So the foreign currency, let's say your revenue, your assets, liabilities, they were of X amount on the opening day of your balance sheet, right? So in the beginning of the year, X amount was there. Now when you are closing your books, the foreign currency, where your branch is situated at, is different. The value of the foreign currency is different than the opening, and there's no possibility to have a very, very slight possibility that the value of the currency in the country where you are operating actually would be same on the opening day of the balance sheet and the closing day of the balance sheet. Certainly there would be some increase or decrease. So some kind of change, positive or negative, is expected in the exchange rate of the country, of the exchange. So in the exchange of the country where your branches are situated in, right? So that is going to lead a difference in your balance sheet. So your transactions were different on day 1 of the balance sheet. The value of the transaction, the revenue would be different at the end of. There are a couple of methods. I am not discussing them here because that is out of the scope of the topic for discussion today. But there are different ways to deal with this. How do we consolidate? That is something different. But nevertheless, the point I want to make out is this. This particular risk is known as translation. When we have to translate the books of accounts kept in the foreign country into our own country, right? So finally at the end, I am the parent company and I have many branches in foreign country. So when I am consolidating, I have to consolidate my books of account at the end of the financial year. So when I am consolidating, I have to take into account the exchange rate at the time of opening up my balance sheet and at the end of the financial year when I am closing up my books of account. So that particular fact is going to affect the exchange rate, your books of account, and is known as translation effect of exchange risk. So let's move further now, and we will talk about sources of finances at international level. How an Indian company, so because I am targeting the international sources of finance here, because we have already discussed domestic source. So how we can procure funds internationally from overseas countries, that is the agenda for this minute. So there are 3 different sources as have been indicated on the slide. We can get euro currency loans, we can get euro bonds and foreign bonds, and we can get depository receipts. We call them as DRs, ADRs and GDRs. So let's discuss one by one all these 3 different options. So first of all, let's take euro currency loans. So how does this euro currency loan work? So euro currency loan is a non-regulated currency loan where investors would deposit their savings in any country than their own country, right? So say for example, we know we have Swiss banks. Many of people have Swiss banks. I won't say a particular set of people, but yes, we already know that people have Swiss banks, and there are many more routes. There's a Mauritius route. There are many routes to get the money from overseas. So, let's say one has excess money and he or she goes and deposit in a foreign bank outside the country, and then the foreign bank who has deposits of a foreigner, if we are depositing there, we become foreigner, right? So, the foreign bank would bundle them together, those small savings of yours, and if there are 100 of individual companies, they are depositing outside, so that would be bundled together, and then that bank gives loans to others. So, small savings by individuals or companies, they are bundled into big amount loans, and such kind of loans are known as euro currency loans. So, this euro currency market has no regulation, they are free of regulation, and then question comes in, how do they decide the interest rate? Because if the loan is there, then some interest rate is applicable, right? So, in the euro currency loan, the interest is based on LIBOR, LIBOR. So, this is London Interbank Offering Rate, LIBOR. So, we call it as LIBOR or LIBOR. So, this LIBOR is London Interbank Offering Rate. So, euro currency loans are given based on the LIBOR plus a margin on that. So, whatever the LIBOR is there, so London Interbank Exchange Rate is there, a certain margin is added by the bank, and such kind of loans are given, are extended as euro currency loans, right? Not bonds, loans. And they are free of any regulation. So, this is something interesting, basic small savings becoming into as a large amount of a big amount of loan. So, since this euro currency loans are of big amount generally in general, so there is no restriction, as I said. So, it means they could be of small amount as well, but as we are assuming, so most of the time they are of a large value. So, most of the banks who are into such kind of loans offering, they would syndicate, they would come together. So, we call them as syndication of loans, syndication by banks and offering of euro currency loans. Okay. So, now let us go to the second category as we shown you on the slide. The second category is euro bonds and foreign bonds. So, euro bonds are basically bonds which require no regulation. Now, they are in the form of bonds, right? And foreign bonds, they require regulation. So, foreign bonds or euro bonds have one thing common, and that common thing is they are issued by somebody outside the country, right? So, so they are basically issued and sold outside the country in the currency of the country from where it has been issued. So, currency remains the same, but they are issued outside the country. They are not issued within the country where the loan is basically raised. So, if we require money here, by any company in our country, the loan would be raised outside the country. So, that is why they are known as euro bonds or foreign bonds. So, euro bonds are free of regulation, foreign bonds are under regulation of the country of their origin. So, this is important. So, they are bound to comply with the regulations of the country from where they have actually been issued. The third is depositing receipts. So, depository receipts are not very old, they are recent few decades only. So, we have two kind of depository receipts. One is ADR, American depository receipts, another is global depository receipts. So, this particular instrument, because that is a financial instrument only, this has come into picture because of one important aspect or fact. In fact, the fact is that developing country, the businesses in developing country are unable to raise equity share capital from overseas. So, because investors from abroad are hesitant in buying shares of the companies in developing countries. So, so the answer is then how to get the equity. So so because of this mindset, this particular concept of depository have come into picture. So what happens if there are, there's a company in India, though we are now considered a very good destination for investment and have maximum FDI flow, so you would be surprised to that. But let's assume there's some country, you can take any African country which is really underdeveloped or developing, and they need equity. So business wants to set up some big plant, they need ownership capital, so equity capital. So they would not be able to get it from an overseas investor. So they would issue share capital to a bank which is known as depositor, and thereafter the depositor would reissue or issue depository certificates against that that capital. So basically, who is now actually issuing you? So you as a retail investor, you are not buying shares of the companies of an African country which is underdeveloped or developing. Rather, you are buying the depository receipts from a depositor, from a bank which is an international bank. So which is a renowned international bank. So now you feel secure, you as an investor, you feel secure to invest in the company, but this company is not getting direct funds from you, and company is getting funds from the depositor. So when the company actually announces dividend, the depositor will collect the dividend and will disperse it to the depositors, whom the depositor have issued depositing or deposit certificates. So deposit certificates, DCs, they are actually issued at the time when an investor buys deposits. So if investors, depositor can issue deposits receipts in America, and those deposit receipts are known as American deposit receipts. There are depository receipts which are issued across the world, and those depository receipts are known as global depository receipts, right? So with this, this particular session is over. Thank you very much for watching this session. Thank you. Good afternoon and welcome back. This is the second part of the session we assume today morning to talk about latest developments in Indian corporate sector, especially with context to international developments. So in the first session we talked about sources of international finance. All the sources which we discussed, they were basically liability side financing. So it's interesting, the word I am using is liability side financing. So all the loans, all the depository receipts, whatever we talked, or loans or project loans, they all are, or bonds even, they all are basically shown in the liability side of the balance sheet of a corporate, right. So, we call them as liability side financing. This has been common in the past from years. We take loan, we issue debentures, we issue even share capital, they all are shown on the liability side of the balance sheet, right. But in the recent years, we have seen there's a more discussion, more talk about financing which pertains to asset side of the balance sheet. Is it not interesting? You are getting finance, but you are not going to show it in the liability side. So how does that happen? I know you would be able to correlate when I am going to discuss in the next few minutes. So we call them as asset side financing or asset based financing. Asset based financing means we need funds. So one is that you get the money and then you buy your asset, right. I am coming up with a new plant, new project, I need plant, machinery, building. So I have an option, I issue bonds, I issue either CD, right, depository receipts, American depository receipts, I get Euro bonds, or I issue Indian capital in the Indian market. So this is one way, but everything is going to go into your balance sheet in the liability side. But my purpose is to bring up a new business. I want to set up a project and I need certain set of assets. I need building, I need machinery, I need plant, I need furniture, fixture, etc., right. So I need to procure certain set of assets. So one option, as we just discussed, that you get loan, you get capital and then buy on your own. Another is that you get your assets financed, right, and then it is not your loan in your balance sheet. So this type of financing is known as asset based financing, where you have someone as investor who buys you assets. It's like getting gift, to a lady, a husband buys something, to a girl, a boy, a boyfriend buys something. So you are getting assets. So at the end of the day, a girl gets the phone, but she has not taken the loan, she has not issued, she has not taken money from anyone, but there is someone who's going to finance it. Just very much like that, just to make, this is on the lighter side, just to make the things easy for you to understand. But in a serious meaning, in serious terms, this is something very interesting, because the ultimate goal is that I should be able to access all those equipments, all those machineries, all those plant and machinery and fixture and furniture which I am going to use in my business. That was the ultimate goal of thinking of getting financed through euro loans or through debentures or bonds, right. So if we have solution, then why not to go for this kind of financing, which is asset based financing. Now the asset based financing, I am going to discuss three things in this. One is lease financing, second is hire purchase financing, and the third is project financing. So in the lease financing, we have two type of lease, upfront and back ended, and primary and secondary. And under that I am going to discuss two different kind of leases, financial lease and operating lease, and thereafter we will talk about hire purchase system and followed by project financing. So let's discuss about lease financing. So what is upfront and back ended lease financing? So let's understand first of all what lease is. So lease is an agreement, it's a contract basically between two parties. One is known as lessee, another is known as a lessor. So lessee is the person who is ready to fund the asset business needs, right, and lessor is someone who is going to use the asset ultimately, so who is in need of asset. So lessor is there and lessee is there. So there is a contract between the two, and they do agree that we will, so the lessor would pay to lessee X amount against use of the asset, right. So this is known as lease agreement. So one thing is important here, lease agreement could be upfront or it could be back ended. Upfront lease agreement is the one where the maximum part of the financing, say if the amount is 10 crore, so the major part of 10 crore, say 6, 7, 8 crores are recovered in early years, and the small amount is recovered later. And primary and secondary lease, they have their own specific features. So lease agreement, per se is a contract. It's a contract between two persons, one who is in need of assets to use for his or her business, another who has surplus of money and is ready to buy you assets, right. So this is what the lease agreement is in general. Now there are two types of lease agreements, or two types of lease in fact. One is known as financing lease, also known as capital lease, and another is known as operating lease. So what's the difference between the two? Let's take capital or financing lease first. In the capital lease, what happens? The lease agreement is for longer term, right, and the right to maintain and insurance. So maintenance of the asset and insurance is with the lessee, the person who uses the asset. So I am buying you asset for long term, almost for the life of the asset. Let's say if the life of a car is 10 years, I am ready to buy you 10 cars. You are a company who is into car rentals. You want to buy 10 new cars. You do not have money to buy. So you approach someone who has money. So he is ready to help you buying those cars. So car ownership is not yours, right? Important aspect is this. The ownership is with the lessee only. So you are someone who is going to use it. So you would be running the car, you would be giving it on the rental, you will be earning the revenue and would be paying the rental for the lease. So lease rentals. But the rentals for the car itself that is your revenue as a company. So you are a company into renting of the car, right? And there is someone who is letting you, select the cars you want to use, you intend to use, and then buy it for you. But the ownership is not yours. They are buying it and giving the cars to you. So ownership remains with the person who is financing it. So you are not obliged to pay the value of the car, right? Car could be, if there are 10 cars and each of them, if let's say for 10 lakhs, this is 1 crore, right? So you are in need of 1 crore. You are a car renting company, you are renting cars, you are running on, you are a taxi, kind of a cab extending or company. So you are extending cab services in the city, and you want to add 10 new cars into your portfolio, and someone is ready to give you those 1 crores, which is the cost of the car. So you need not to take loan, and you did not take loan in fact. So this is not loan, mind you, because had it been loan, then it would have been the liability side of the balance sheet. And the point I made is that we are talking about the asset side, asset based financing. So you got the asset cars, and the actual financing is done by someone else. You are earning revenue in terms of car rental, and you are paying the lease rentals to the person. So if it is the capital lease, the life is almost equal to the life of the asset which has been purchased. So in general, so as of date in our city, Delhi, we have the life of a car run at diesel is fixed. We know 10 years. So car which is run at diesel cannot be used beyond 10 years. This is a legal regulation as of date in the city, right? So the point I am making is this kind of lease would be known as capital lease, which is for long term and almost for the life of the asset. But there is no, in Indian context, there is no such clause in the lease agreement to let the person buy it after use. So I am using it, and whatever the scrap value of the asset is, that belongs to the lessor, right? So lessee is that belongs to lessee, the person who has bought it for you, right? So the second category of lease agreement is your financial lease. Operating lease. So financial and capital lease is one and the same thing, so which we have discussed. Now the second category of lease we are discussing is operating lease. Now the operating lease, the one fundamental difference between the capital lease and the operating lease is this, that the operating lease is of short term life, and it is never going to cover the full life of the asset maximum. So generally, if the life of asset is, say for example 10 years, this lease could be for 3 years, 2 years, 1 year, like that. And since the life is very short, the expenses of maintenance of the asset and of the insurance of the asset, that is borne by the someone who buys it, by the owner, right? So lessee, the owner, is going to bear the cost of insurance and the cost of the maintenance. I have seen, I am into the academic industry, education industry. So I have now seen the many academic institutions, they have stopped buying printers, they have stopped buying even laptops used by the faculty members. What they are doing, they are actually getting into lease agreement with the companies and paying the rentals. So this is saving them in terms of upgradations, because technology sees so much fierce change and competition in the economy. So if as an institution, academic institution, I intend to teach my students the latest softwares, so I want them to use the latest machines, the latest computers and laptops, so machines. So I need to have them changing them frequently. So it becomes a capital expenditure for academic institutions. So this is the latest trend in the industry I am working in, that people have started buying or using they have stopped buying printers and laptops. They are using it on lease basis under the lease agreement. So that is a particular trend in academic institutions which I am sharing now. So that is under operating lease. Not the capital lease, not the financing lease. So the academic institution would be paying rentals for the printers or for the laptops or computers they are using, and which actually belongs to someone else. So academic institution doesn't own it, right? The ownership remains with the lessee. So you are, as a lessor, you are using it, and the lessee is who is actually extending the asset to you for use, is going to maintain it, is going to get it insured. One important aspect which is obsolescence. So if the asset get obsolete, especially the printers, laptop, mobile phone, etc., if the asset get obsolete, the loss of obsolescence is not with the person who is using it, it is with the owner, because you are not owner. I discussed it. Ownership is with the person who financed it, who bought it for you. So this is another important aspect of lease financing, right? So let's go to the second asset based financing, which is known as hire purchase financing. So kindly pay attention, because the demarcation line between hire purchase financing and the lease financing is very thin. There is not much difference between the two, so it is important to pay attention on the details. So in hire purchase financing, what happens? I need I need 10 machines, 10 color sorting machines. As a business, I am into rice milling. So I am a rice milling machine. I need color sorting machines. So there are companies, and color sorting machine is not less than 1.5 crore as of date minimum, right? So it's 1.5, 2 crore, 3 crore color sorting machine. So if I need 10 means if it is 1 crore, so it's a 10 crore investment for me, right? So I think I should not be buying on my own. I should be rather going for hire purchase system where I am paying in installment, right? So the moment I decide to buy on hire purchase, the asset comes to me for use, and I would be paying from my future revenues in future. So ownership is not transferred to me the day I access the asset. Ownership remains with the color sorting machine or with the hiree. So hirer, you are hirer. So hiree is so you are hiring, you are allowing you are buying it, or you are a manufacturing, you are allowing someone to hire from you, right? So the hiree who is using the asset, he is not going to be the owner till the last payment is made, till the last installment of the hire purchase price is made. But asset comes into the possession of the person who has get into agreement to use it or to become as a hiree, right? So now there is one important aspect. Most of the times in Indian corporate sector, so not at retail level, we see that we do hire purchase in for domestic products as well. We have seen there are many hire purchase options available, especially now in the next month when we have Diwali on the head. We will say the options are there to buy a TV on hire purchase, washing machine, all electronic goods are on hire purchase. I have seen the latest mobile phones, which is very expensive, is available on hire purchase system, right? But for corporates who are going to buy assets for long term use, if they buy, then there is something different. Then what happens? The hirer who has to use the asset, he would select the model, the make, both, and then he will find someone who is either manufacturer or independently lending money for hire purchase purposes. So who is known as hiree. So hiree and manufacturer, either of them is one. So if they are same, they are common, then so they would buy those assets which have been selected by you as a corporate. So you would choose the asset because you have a certain requirements, a specific requirement with context to color sorter. So you want to buy say Stakia or Buller. So you can decide. I know the two major companies. I have worked into the food industry, so I can actually correlate with this. So there are two color sorter manufacturer. One is Stakia Corporation and another is Buller Corporation. So they both are Fortune 500 companies. So if the rice milling company XYZ Limited, they decide to buy X machine, either of the make I mentioned. So now the rice milling machine, the miller would ask the either the manufacturer if they let the machine on hire purchase, or otherwise would find out a person who is ready to finance it, right? You are not financing it, you are not buying it, you are not paying the full money today. So that's how the deal goes in. So there's a difference in retail, and in retail we generally don't select for the purpose of who is going to be my manufacturer or hirer. We generally go by those suppliers who are actually selling it on hire purchase. It is already known that X or Y product is available on hire purchase system. Whereas in the corporate sector, we would select the product because we have certain specific requirements, and then we will approach either the manufacturer or the person who is into it for financing based on asset, and then we will get the asset. So this is how the hire purchase system works. So as I said, the major difference between the lease financing and hire purchase financing is this: the ownership. The ownership remains, the moment the person who has purchased on hire purchase system pays the last installment at the end of the agreement, the ownership comes to the person. Whereas in case of lease contract in India, I am talking precisely about India, the ownership doesn't comes to the lessee, it always remains with the lessor, and because if it comes with the with the lessee, it will become as hire purchase system. So lease will convert legally as hire purchase system. But in US we have a different system. In the agreement itself, in the lease agreement itself, it can be said that the asset can be purchased, and the purchase price can be even decided at the time of the writing the lease contract. That asset can be purchased at a specific price at the end of the lease agreement. So such clause is there in many other countries, but not in India, legally not allowed. Then the last is project financing. In the project financing, the financing could be precisely for the whole project. So not only one asset is being financed, but the whole project is being financed by some financing institution. So these are the three asset based financings. The last thing I want to talk is factoring and forfeiting. So this factoring and forfeiting are two important developments in the recent past only. So in factoring, what happens, the accounts receivables, this is also a source of financing. So under financing only I am discussing that how can one get the finances. So they are basically sources of trade finance. Sure. So in factoring, there is one company or individual known as factor who would buy your accounts receivables and pay you outrightly. And this purchase can be under two different conditions. One is without recourse and another is with recourse. Without recourse means in case the person who was supposed to pay you, the person who issued receivables, and he or she doesn't pay, then this factor can come to you and collect from you. So this is with recourse. And if this option is not there, so the factor has no right to come to you, and in case factor is unable to collect from the payer, from the creditors, so this would be his or her loss, right? So this is known as without recourse. So with or without recourse, but for a businessman this is a source of financing. So basically I am selling off my receivables, I have trade receivables and I am selling it off to a factor and getting money for my immediate use. The forfeiting is also similar, but a major difference between forfeiting and factoring is this: in factoring we are selling short term receivables. In forfeiting we are selling off our long term receivables to a company, and they are paying you outrightly, so you get the money, so you get the financing, and then later on they would be collecting on their own. So forfeiting is basically for used by exporters, so who have some some kind of support is there, because we would have some banks guarantee involved in the export agreement. So exporters would generally sell off their receivables, long term export receivables, to a company who is into forfeiting and get the funding. So this is another way of getting the finances. So these are all the financing means which we discussed today. I hope you could gather the discussion. Thank you very much for watching this show for an hour. Thank you.
Thank you, ma'am. Thank you for your precious inputs to the lecture. Dear friends, if you want to give a feedback for today's lecture, then do write to us at info.cec@nic.in. We would be meeting again very soon and would be discussing more. Till then, take care. Goodbye. Thank you, ma'am. Thank you, ma'am.
Thank you, Geetika.